Welcome back. We're with David Burrows. All right, David, let's start the show. Invigorating discussion to kick off market call on BNN Bloomberg. But let's start with an email now from Laura. She's curious about a utility stock recommendation. Which one would you get into if you're in the mood to buy? Utilities are hot right now, given the turmoil.
Look, let's first recognize that utilities are the most crowded space in the market, okay?
Yep.
Lots of people looking for defense, and valuations are certainly not cheap. So they may not be quite as safe as everybody thinks, but let's decide where we would go. What I would want to have is something that has above average dividend growth and has an opportunity to grow faster than the universe. So we own and have owned now for years NextEra Energy, NEE in New York. NextEra has about 30 to 35% of their revenue coming from renewables. If you are an ESG investor, scores very, very highly on ESG. And renewables are becoming very, very cost competitive against carbon-based utilities. So NextEra's had very good dividend growth. It's not the highest yielding utility, but you're looking for total return, consistency. And so they have a solid lead. They're based in Florida. They have a really strong and growing customer base. And I would buy this for both combination of capital growth plus some yield.
Okay, let's switch over to some commodities now. We'll get to David in Toronto. He would like to know about AltaGas. He says, when I purchased this last October, I set an exit price for $21. Should I continue to hold past this exit price? If so, where would you exit?
Yeah, we would be a little bit careful with AltaGas. The balance sheet is stretched, so there's a fair bit of debt. Dividend growth is unlikely to be significant going forward. So again, I would be encouraging. I am firmly in the camp that we are going to see a soft landing in the economy in the U.S., much like 1995.
Right.
They raised rates through 94. Everyone thought there was going to be a recession. Data slowed down for the first half, then reaccelerated. So I think it's very possible you're going to see money come out of some of these really predictable positions that everyone's been piling into things that are a little bit more economically sensitive later in the year. So
later this year.
Yeah. So unless you think in the yield plays you have that you have dividend growth, I don't think you want to be there. And I think that this is going to be challenged from a dividend growth perspective.
Okay. Let's bounce over to CCL Industries. Jared in Ottawa wants to know if you would consider buying some shares here. They did have a problem with resin prices, right? I think that's since been resolved.
Yeah.
Would this look good to you? Is this promising?
Okay, so it depends on the kind of investor you are. If the thesis here is that the best part of their business is their pressure sensitive labels business.
Right.
It's a highly fragmented industry. They have like 160 facilities around the world. They continue to make acquisitions. So this is a cash flow machine. They make an acquisition, they take on some debt, they pay it down, they make another acquisition. They've been excellent at buying and integrating in a highly fragmented space. In the very short run, they're always sensitive to commodities prices, and it can have an impact. So stocks pulled back from $68 at 64, sort of $4 off the high. If you think global economy is okay and the consumer is okay, and many of the companies in the consumer space in the last quarter said the global consumer is in great shape. I think this is a great company. Now, you know, it's not the most heavily traded stock. It's hard for institutions to be big buyers unless you're sort of a buy and hold investor. But I like the stock, and I'd buy it here.
I go back to China, though. How solid is the U.S. consumer when you look at, you know, say a Costco shelf or a Walmart shelf, David, and all you see is everything made in China, made in China, made in China.
U.S. consumer.
You know, if they stop sending their stuff over, if we stop getting that cheap stuff on our shelves, just how long can the U.S. consumer continue
The U.S.
carrying?
consumer is in the strongest place it has been in 20 years. They've paid down debt. They're in a very strong place. Consumer confidence is good. Now look, there's going to be companies that are going to be challenged because their costs are going up, and there's going to be things that come in behind. But I think that the U.S. consumer is in very good shape, and I think that there's probably way too much pessimism.
Okay, let's get to the. It's hard not to be, for a lot of folks, to be pessimistic, especially if you're sitting at home and you're watching yesterday's Gong Show basically take place. As China basically got in trouble for doing something it didn't do, which is it didn't step in to manipulate its currency. That's the problem, right? They didn't get in and try to keep the yuan higher.
Look,
that was the essence of yesterday.
There is news.
One would think.
There's news all the time, and I don't want to minimize it, right? But the reality is we're investing in companies. We're investing in companies with really great earning streams, and for sure sentiment has an impact on markets. But remember, like 2 weeks ago, we made an all-time high in the S&P against a lot of pessimism.
Right.
Earnings came in better than expected, and we'll see how revisions go going forward here. We've just started a rate cutting cycle, and the likelihood of another cut in September is very, very high. I don't think you want to fight the Fed.
All right. Would you, in the meantime, get defensive with a company like Raytheon? We got an email from Rachel. She wants your thoughts on the defense sector in general, and then making a play potentially like Raytheon. Right.
So I've recommended maybe for 3 or 4 or 5 years defense stocks on this show. We've been big shareholders in Lockheed. We've owned Raytheon in the past. Raytheon's going through a merger, so I think that there are some question marks around how that's going to come out. I'd probably rather buy Lockheed Martin. Lockheed Martin, a little longer cycle contracts that they have, very, very good visibility, trading a new relative high versus the S&P. You're not dependent so much on the economy. You're dependent on governments around the world spending money on defense, which is an undeniable ramping up of spending. So I like Lockheed Martin. We own TransDigm, which is having a very good day today. They make systems that go into both Boeing planes and Airbus planes. It's up 14% today. I think the aerospace and defense sector is one that continues to be leadership in the market. I just think Raytheon may not be the strongest place to be.
Okay, we're going to come back. I'm not sure it's the next segment, but a bit later in your show, we'll be discussing Boeing. That was one of your past picks, and we'll continue the conversation on aerospace. Let's take a break here with David Burrows, President and Chief Investment Strategist of Barometer Capital Management. Our number, we'll take your calls next, 1-855-326-6266. We'll see you in 2.